David, are you surprised at the extent of the rand's resilience at this stage? It's weakened a little bit, 7.48 against the dollar, but just given what the dollar is doing against the euro, would you have expected more rand weakness?
Yeah, I'm a little bit surprised, Stephen, but I guess it just goes to show that for the rand, largely the year is over, and there's not a lot of activity going on at the moment. Really benign, and it seems as if all the corporates have done what they needed to do. I don't think foreigners are playing very actively in the rand at this point in time. So, unfortunately, for the rand, the year is largely finished.
So, would you expect the rand really to end the year around current levels?
Yeah, I think somewhere between 740 and 760. We'll end around those levels. The dollar has strengthened quite sharply over the last few sessions, and that's on the back of the US withdrawing some of the warning that they're going to withdraw some of that liquidity. But really, the rand holding up quite well on against the crosses.
Of course, the US Fed said it was going to keeping interest rates unchanged for the time being. But do you think there's a growing perception, perhaps in the market, that interest rates in the United States are going to be rising sooner rather than later?
Yeah, the market expectation is fluctuating a little bit between sort of the second quarter of next year, anywhere up towards the first quarter of 2011. But certainly the US economy has improved. It looks like they're on the verge of creating some jobs, and hence we've seen the dollar strengthen on the back of those issues.
David, you said we'd been holding up pretty well against the crosses as well. How about our emerging market and commodity peers? How have we fared according to them?
Yeah, we're thereabouts. In fact, we strengthened a little bit. The Australian dollar took some pain as well. And the rand traded as strong as 7.35 in our holiday yesterday, but that's really in a thin market with no liquidity. So rand doing relatively well against most currencies at this point.
David, you said the Fed ending special liquidity measures early next year. To what extent have these liquidity measures, in your view, been supporting the markets and the economy in the United States?
I think there's no doubt that they have played a role. The only problem is, up until recently, we haven't seen much impact on the jobs front. That looks set to change as the US probably will create some jobs in the next few months, and that's a real indicator, together with inflation. If we see some inflation coming through into the US, then I think the Fed will be a little bit more feel a little bit more at ease to withdraw some of that liquidity, and perhaps even hike rates in the first half of 2010.
Is there still a concern in the market, though, that it might be withdrawing some of that liquidity too soon, and interest rates might be going up too soon, and we could see that double-dip recession creeping back in?
Stephen, that's the big debate at the moment. The timing is going to be all critical in 2010, when those special measures come to an end and when rates begin to rise. There are a few warning lights on the horizon, and one of those is the massive amounts of liquidity that are fed through into the bond market globally, and what the impact of the withdrawal of that liquidity is going to be on the markets. And exactly as you say, the threat of a double dip recession, that's what everybody will be concerned about. And I guess the timing is going to be up to Mr. Bernanke and his colleagues to get it right, to make sure that the economy continues to grow and we don't affect sentiment.
Bringing it back home, perhaps, we had producer inflation figures out just a short while ago. Producer price index contracting by 1.2% last month, and that was smaller than the 1.8% fall expected by economists. What's this telling you, David?
I think PPI and CPI are now going to, I think, diverge a little bit. PPI has led CPI down. I think CPI has still got a little bit of room to go, and perhaps it opens up an argument for an interest rate cut domestically early in the new year. But I think we'll just have to wait and see, Stephen. I think PPI is now tracking what's happening globally on the inflation front. Perhaps CPI still got a few months to catch up.
Well, David, it's been quite a momentous year for the rand. We started really on the back foot, very close to 12 to the dollar, ending around 7.50 to the dollar. Any predictions for what's going to happen to the rand in 2010?
Yeah, I think there's two main issues for me, or a few main issues for me, Stephen, looking into 2010. The first one, of course, is we're going to see very good positive sentiment created from the impact of the World Cup. The first 6 months of next year, I think there'll be some generally good sentiment in the economy and in the country in general, and that will feed through into some positive sentiment for the rand. But beyond that, I think a lot of that is priced in at the moment. But beyond that, a couple of warnings. The one is the withdrawing of the massive amounts of liquidity from the global system and the impact that that will have on the currency. And the second issue for me is how the economic policy debate plays itself out in 2010. In the last quarter of this year, we've seen some vociferous debate coming about from the likes of the trade unions and the Communist Party, the Reserve Bank and the government. And in fact, everybody's expressed a little bit of concern about the strong rand and the impact that's having on manufacturing. So for me, it will be very key to see how the debate plays itself out and where economic policy is headed. So those are a couple of the issues for 2010.